Realty Income and VICI are two of the most popular dividend investing REITs in the investing community today. They're often talked about for their giant dividends, but which is the better REIT to own long term? So today we're going to be covering their financials, their price to AFFO ratio, how I think their growth will look in the future, and so much more stuff. And at the end, we're going to determine and come out with the conclusion of which could be the better REIT long term. And guys, we've been slacking here recently. Only 13% of you guys that are watching this right now are subscribed to the channel. So if you want to be more than just a statistic on the channel, make sure to hit that subscribe button. On this channel, I promote real man's investing, actually looking at businesses, not buying stocks off of fear or hype, and copying other people's portfolios. With all that out of the way, roll the intro.
Hello, I like money.
Alright, let's talk about both REITs before we get into the financials and all the juicy stuff in it. So, I did make a video on both of these companies going over the business in more in depth of what I'm going to be talking about today, though both links in the description. To start off with Realty Income stock ticker O is currently trading at $49 per share. Over the last 5 years, it is only up 2%, and that's including total returns. Now, I'm not a fan of really bashing stocks when they've been on a big decline as of recently. Realty Income has fallen a lot in the last couple of months, and I don't think it would be fair to really look at it from a price standpoint right now. But regardless, they still were pretty much underperforming. They were doing pretty well a year or two ago when a lot of dividend investors were looking at real estate and real estate companies like REITs to be kind of a hedge against inflation. Unfortunately, interest rates have pretty much wiped that out now, and everybody thinks retail is going dead. Realty Income's main client base is a lot of gyms, retail companies, convenience stores, and a whole bunch of other stuff that I go over in that video itself. They have a 98% occupancy rate compared to VICI's 100%. With that said, though, they do have a lot more diversification and a lot more properties than VICI, which I mean you could view in one way or another. You could view it as a good thing as they have more diversification, so if one thing goes wrong here, it's not the end of the world. But they're in a lot of industries that a lot of people think are going out of business, are going digital, movie theaters, gyms, retail, especially companies like Walgreens who have been struggling a whole lot recently. This and the high interest rate environment has really contributed to Realty Income's downfall over the last couple of months. Now, with that said, do I think Realty Income's fundamental business is going out of business and it's going to go bankrupt? Probably not. With that said, though, I would say there is definitely some real risk and some real concern with some of Realty Income's tenants right now. For example, retail stores. If you're looking at stores like Rite Aid right now that are filing for bankruptcy, and some of their competitors like Walgreens that is tenants right now to Realty Income, there is some serious risk. So I think I would definitely keep that in mind with them. Alright, let's move on to VICI, and this is the way more beloved company at the moment by a lot of investors. VICI, stock ticker VICI, is an experiential-based real estate company. This differentiates from Realty Income's more retail-based real estate. VICI owns the land to all these experiential and popular-based places across the world that people go to basically have good experiences. A few years ago, they were basically just concentrated in Las Vegas and owned a huge part of the Las Vegas Strip, which they still do today. The Las Vegas Strip is one of the most coveted vacation destinations in the entire world, and it's irreplaceable real estate. I think that's what's making it way more appealing than something like retail right now, which more Realty Income is way more concentrated in. Realty Income is also making investments outside of Las Vegas too, as they have for the last 2 years. These are accretive acquisitions, which means they're not diluting the shareholder. VICI actually just announced a new investment into some bowling alleys in their last quarterly report. So VICI is making a lot of investments into unique experiences and unique land that can't be really replicated, unlike some of the retail. Something else I think to mention with Realty Income is that they've been making some investments as well. They've invested in the Las Vegas Strip, they invested in a Wynn Resort, and are making more investments towards the experiential-based real estate right now. Now, something to keep in mind as well is that VICI has been around way shorter than Realty Income has. They've only been around since 2018, and there's not been much long-term proven track record when it comes to their dividend growth, price appreciation, or whatever. But it doesn't take away from the fact that their fundamentals are still very strong as a business, which we'll get into. Alright, let's check out the total returns and the performance to see how they've done in the past. And guys, remember, total return includes dividends. Some people from the Tesla video may not understand that still, but total returns do include dividends. Over the last 1 year, which is a very micro time frame, VICI is down 6.25% and Realty Income is down 15.74%. guys, keep in mind we don't have any long-term track record of this, so keep this very bluntly in mind. So we can see in the short term, Realty Income is definitely being punished for that retail exposure that they have. The longest time frame that we have available, because VICI went public in 2018, is the 5-year chart, and we can see over the last 5 years, Realty Income is only up 2.73%, which is a horrible return. Now, guys, please do keep in mind, I own Realty Income myself, and this is a bad time to be kind of comparing them to when it comes to the price appreciation side of things. I guess if you really wanted to be fair, we could try to price them around $60, but still they're underperforming. I'm just not a fan of pulling up a stock's total returns, especially when the stock has been trading down like it has, like 20% over the last 1 year. I do prefer kind of finding a 5-year average to compare apples to apples to. While VICI stock has gone up a crazy 93.12%. Now keep in mind, VICI is growing a lot right now, especially for a REIT, since it did become public very much recently. For a real estate company, and I don't think VICI will have this type of returns going forward, but I still do think you can get very solid returns with VICI. Another thing to keep in mind with VICI too is these returns are even priced in after their stock price has gone down a lot recently too. So let's see moving forward how a one-time investment of $1,000 would perform for you over the long term with these two REITs. To start off, we plugged in VICI. VICI's current stock price, the annual dividend, the expected dividend growth, which I put at 4%. Now this is going to be a long-term projection, so the longer time frame you're in, the lower the dividend growth that you're going to go, because realistically, some of these companies just can't maintain the 12% annual growth rate, even though VICI's dividend growth has been stronger than the 4% as I mentioned. And I put in an expected stock price appreciation of 8% for them, which is pretty much in line with the S&P 500, and which is what they've been doing for the last couple of years. And that kind of price appreciation also could make up for if they did grow their dividend more aggressively than what I'm putting in. And we can see over a 35-year time horizon, your one-time $1,000 investment in VICI would turn out to be $48,758.13 reinvesting your dividends. That's incredible. If you were not to reinvest your dividends, you would have almost 75% less of a return. This just shows the effect of reinvesting your dividends and the dividend snowball effect, especially when you have great companies like VICI that consistently pay and grow their dividend. Alright, putting in Realty Income's value projector, we have them coming out at a current stock price right now, $49 even per share, an annual dividend of $3.07 per share. I put an expected dividend growth rate of 2%, which I think is what they're going to be maintaining, a dividend frequency of every month because they pay a monthly dividend, and expected stock price appreciation of 3%, so that comes out to about a 5% gain every year. I think this is probably what it's going to average out at, especially if some of the retail kind of hurts them as much as analysts are expecting. And you get a whopping $17,494. That is down a lot from the around $48,000 that you would be getting from VICI. But don't worry, at least you get your monthly dividend at the beginning. At the end of the day, guys, with Realty Income and VICI, it's not apples to apples in the case that they haven't been around for the same amount of time, but at the same time, they are both real estate companies. VICI is definitely going to offer a lot more long-term growth potential, where Realty Income's a staple. It's most likely not going to go anywhere, but you're not going to be getting any crazy gains or anything like that, which is kind of the price you do pay. With that said, what do I own? I own both of them right now. If I were to get out of Realty Income at a solid price, I would definitely be open to doing that though, but I have been loading up on VICI recently. I also don't believe that it's fair to look at Realty Income right now when it comes to a total return and kind of a price appreciation standpoint comparing them to VICI. They're both wildly different REITs, as I mentioned. Realty Income is way much older and way more established than VICI is right now. But at the same time, everybody's investing goals and strategies are different. I'm looking for a lot more growth. You may be looking for that retirement income. We all vary. If you're wondering what that fine-looking projections tool that I was using at the end of the video was, it was DividendData.com's Future Valuation Projector. You could play around with it. That's what she said. Get access to a bunch of stock research tools. It's the ultimate time saver at the end of the day. You can also run value projectors on your favorite companies to see where you're looking to buy them. With online free resources, it would probably take me 2 or 3 hours to research stocks. With DividendData.com, it takes me just over 10 minutes. It's all in one place and it's super efficient. Check it out, the link's in the description. You can try it out for 2 weeks free. If you like this style of video with comparing two companies, let me know in the comments section. I'd also greatly appreciate you hit that subscribe button for me. Smash the like button, and of course, do dividend stocks, not drugs. Have a good one.